In this session, we will begin to explore the subject of distribution. Before I begin, let's make one thing clear. The distribution schematic I am using as a visual aid is possible, but don't think that it will unfold as neatly as it is depicted in the chart. Treat it as a visual aid, not a prediction. To understand the concept of distribution, you must understand that institutional players don't buy or sell financial assets with a short-term perspective. Additionally, their trading activities are driven by strategy rather than emotion. Their method of operation is simple. They accumulate the supply on the way down and sell on the way up. The distribution phase begins when institutions identify a resistance zone where supply begins to outstrip demand. However, because the uninformed traders are not as aware of this resistance zone, it allows them to distribute their holdings without triggering an immediate downtrend, setting the stage for the distribution phase to unfold. You must understand that distribution is not a one-time event. It is a process that could take weeks and months to complete. Generally, in the distribution phase, institutions offload assets into weakening demand, which coincides with Elliott Wave's fifth wave, the final surge of an uptrend driven by retail enthusiasm. This integration of Wyckoff's supply-demand dynamics with Elliott Wave's cyclical structure helps traders pinpoint institutional selling zones. The Wyckoff distribution phase is subdivided into 5 stages, phases A to E. In this session, I will explain Phase A of distribution. Phase A of distribution includes 4 stages. 1. Preliminary supply marked with the initials PSY. 2. Buying climax marked with the initials BC. 3. Automatic reaction marked with the initials AR. And 4. The secondary test marked with the initials ST. Now we will move to the actual price chart and discuss these stages at length. Preliminary supply. As mentioned earlier, Phase A marks the start of distribution, where demand begins to falter before the price reaches its peak. The first event, preliminary supply, occurs when institutions initiate heavy selling after a strong uptrend, creating resistance. This is signaled by widening price spreads and increased volume, indicating the uptrend may be nearing exhaustion. From an Elliott Wave perspective, preliminary supply often follows Wave 1 of 5, where the price tests significant resistance, such as the prior Wave 3 high. After preliminary supply, the price enters a consolidation phase, Wave 2 of 5, resembling a Wyckoff trading range where institutions pause selling to assess demand before resuming distribution in Wave 3 of 5. Take a look at the chart. The zone marked in red, between $110,000 and $112,000, which was the previous all-time high, serves as preliminary supply. You can see that it marked the top of Wave 1, or A, depending on the chart interpretations that I explained in the previous video. After hitting the preliminary supply, the price pulled back, gathered momentum, and broke through. The term buying climax is self-explanatory. It marks the peak of aggressive buying where price volatility and intense demand from retail traders reach their height. This is when the public's euphoria drives heavy or urgent buying, which is met by institutional sellers, whales, quietly offloading their positions at elevated prices near a market top. From an Elliott Wave perspective, the buying climax typically aligns with the peak of Wave 3 of 5, the strongest impulse wave characterized by high momentum and volume. In some cases, particularly in extended trends, it may coincide with the end of Wave 5, marking the final push of the uptrend. Currently, Bitcoin is in the initial stages of the buying climax. Therefore, I cannot demonstrate the actual price action, and I am relying on the schematic outline. The buying climax phase begins with the breakout above the preliminary supply resistance line, marked on the chart with an orange arrow, and ends when it ends. Nailing the absolute high is not as important. What is essential is pattern recognition. The pattern consists of an almost vertical price move without a meaningful pullback until the buyers are exhausted. Ultimately, only the pullback and the forming of the distribution range confirm the buying climax. However, there are signs that the market is nearing a buying climax, such as 1. A bearish RSI divergence, 2. Increasing volume leading into the buying climax event, 3. Price volatility, 4. A diminishing spread, meaning that as the price was getting closer to the top, the daily candle's price range became narrower and narrower. In addition to the clues the daily chart provides, the weekly chart can provide us with further confluence of a forming top, such as 5, a touch of the 1-1 gone angle, 6, Fibonacci price extension levels. Let's go over Bitcoin's previous all-time high of $73,800 in March of 2024 and review the daily chart for clues of an impending top. Leading to the buying climax event of 2024, we can see high volume nodes marked in blue leading into the buying climax event. Ideally, we would like to see the high volume candles just before the buying climax event, a day or two before the actual top, but this is the difference between theory and practice. You can see that the second high volume node involved a considerable degree of volatility, which is an indication that the Bitcoin bears were sensing the buyer's exhaustion. As the price approached the buying climax event, the daily candles narrowed, and the presence of upside and downside wicks indicated a weakening of the buyer's strength. Now let's move to the momentum indicator. As you can see, the RSI indicator shows a distinct bearish divergence. Now let's move to the weekly time frame and see what clues it gave away. On the weekly chart, we have two TA elements. One is the 1-1 gone, 45-degree angle, and the other is the third Fibonacci extension. Although the 1-1 angle didn't act as neatly as it did in the following top, it is still acting as a diagonal resistance. Couple that with the third Fibonacci extension acting as a horizontal resistance, and both elements together create an impenetrable barrier to the price. As analysts and traders, we need to add up all these seemingly unconnected data points, make the connections, and draw up our conclusions. In the case of the 2025 Bitcoin peak, time is on our side. Every day gets us closer to the point where time and price will align, and these clues will whisper in our ears, it's time to get out of the market. After the buying climax event comes the automatic reaction, which is labeled as AR. According to the Wyckoff terminology, the automatic reaction signals a demand exhaustion. Essentially, the quote-unquote whales continue selling into the rally until it becomes unsustainable, and a correction is needed to restore balance between supply and demand. The bottom of the automatic reaction defines the distribution range. From this point forward, the price will not go significantly above the high of the buying climax or below the low of automatic reaction. This makes the trading decision process easier, because if the price falls below the range and retests the distribution range low as resistance, it's a sign that the distribution process is over and the markdown phase has begun. On the other hand, if the price breaks through the distribution range high with a retest, you'll know that this wasn't the buying climax event, and you should expect higher prices. Let me illustrate this with a practical example from Bitcoin's recent price action. You may not be familiar with some of the terms, but hopefully everything will become clearer as we progress in this series. Currently, I am considering the price action defined by the parallel channel, marked in yellow, as a reaccumulation range. The mechanics of the price are the same in distribution and reaccumulation. We can identify the buying climax event on May 22nd at $112,000. The automatic reaction event concluded on June 5th at $100,300. The secondary test was on June 9th at $110,650. The spring action was on June 22nd at $98,000. The breakout, or the jump across the creek in Wyckoff terminology, was on July 8th. When and how will this breakout be confirmed? If the price makes a higher low above the distribution range and proceeds to make a higher high, I'll know to expect continuation. If, however, the price fails to make a higher high, and especially if it falls back into the distribution range, I will consider it a failed breakout and expect lower prices. If the price falls below the automatic reaction and retests it as resistance, it is a sign that the distribution is over and the markdown phase begins. In the next slide, I will expand more on the automatic reaction and the secondary phase in the context of the Elliott wave theory. What I am going to do now is to bundle together the automatic reaction, the secondary test, and the sign of weakness. If we go by classic Wyckoff theory, the sign of weakness event belongs to phase B of the distribution, while the automatic reaction and the secondary test belong to phase A. However, in the context of the Elliott wave theory, it's all a part of the same correction. I have already explained the automatic reaction, but I'll repeat it to ensure we're all on the same page. 1. Automatic reaction, marked with initials. AR is a sharp, rapid price decline following a buying climax, triggered by profit-taking and exhaustion of buying pressure, often signaling the start of a distribution phase or a temporary pullback as demand weakens. 2. Secondary test, marked with the initials ST. The secondary test is the stage in which the price revisits the area of the buying climax to test the demand-supply balance at these price levels. If a top is to be confirmed, supply will outweigh demand, and volume and spread should be diminished as the market approaches the resistance area of the buying climax. 3. Sign of weakness, marked with the initials SOW. In Phase B of the Wyckoff distribution schematic, the sign of weakness is characterized by heightened volatility and increased volume, signaling that supply is overpowering demand. Leading into the sign of weakness, the market often tests or breaches the horizontal support level established by the automatic reaction. In this lesson, we covered all the components of Phase A of a distribution schematic. We explained the concept of preliminary supply and how to confirm a breakout. We explained the buying climax event and how to identify it. We explained the automatic reaction that follows the buying climax events, the secondary test, and the sign of weakness. We also learned how these components of the distribution schematic fit with the concept of an ABC correction. If you managed to stay with me so far, I salute you. Please write down your questions and suggestions in the comment section, and I promise to get back to you as soon as I can. Cheers.